Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's webinar on the theme Checklist on Standards on Auditing. As we all are aware that the topic is very important, and yesterday we have organized first part of this checklist on standards on auditing covering 200 series. Today we are covering 300 series of the standards on auditing and going to cover the checklist for SA 300, planning and audit of financial statements, SA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment, SA 320, materiality in planning and performing an audit, SA 330, the auditor's responses to the assessed risk, SA 402, audit consideration relating to an entity using a service organization, and SA 450, evaluation of misstatement identified during audit. As we all are aware, this 300 series is very important, and in order to tackle these standards and checklist relating to that, we are having with us very learned speaker, C.A. Shraddha Kirsara ji, on behalf of AASB of ICAI. I extend warm welcome to you, ma'am, on this Zoom platform for the webinar organized by AASB of ICAI. Namaste, ma'am. Welcome to you. I also welcome all the participants of today's webinar. Before we formally start, I would like to share with you the brief profile of today's learned speaker, C. Shraddha Kirsara ji. Shraddha madam is a chartered accountant with expertise in leading teams in conducting statutory audits for large and complex clients across sectors for a Big Four network firm of high repute, currently working as a partner with Big Six audit firm. She's a chartered accountant and a company secretary with over 13 years of rich experience in conducting statutory audit of automotive, manufacturing, engineering, renewable energy, IT, and ITS clients. She has managed audits of large listed group companies which are part of the Sensex 30 and Nifty 50. She has led India's AS implementation of one of the leading automobile and private sector pharma company. She has superintended audit of standalone and consolidated financial statements of conducting statutory audit as per the Indian GAAP, Indian AS, IFRS, tax audit, VAT audit, and certification. She has led a team of more than 10 people to deliver audit services to the various clients and worked on challenging clients and reported to the senior partners and senior client stakeholder. She has delivered various lectures as well as the various webinars and virtual CP meeting on various platforms organized by the Institute of Chartered Accountants of India. She is a regular speaker on various topics like accounting and auditing and various other topics relating to the auditing. She is having practical and solution oriented approach without compromising the audit quality. She is an effective leader with excellent and motivational skills to sustain growth and momentum while motivating peak individual performances. As far as his qualification is concerned, she is a company secretary from Institute of Company Secretaries of India, as well as she has cleared in she has cleared her company secretaries in her first attempt. She is a chartered accountant from Institute of Chartered Accountants of India in the 2008, cleared in her first attempt. M.Com from University of Pune in 2009, B.Com from University of Pune in 2007, and she has also done diploma in IFRS from akka UK in 2010. So list is still very vast. So without wasting much more time, I request Madam to please deliberate on various standards on auditing and the checklist available for that. Over to you, Madam, please.
Yeah, thank you, Anilji, for a warm welcome. Thank you for inviting me on this for discussion on this very important topic regarding checklist on standards on auditing. I'll just start sharing my screen.
Yes.
Yeah. Is it visible now?
Yes, ma'am.
Yeah. So, as Anilji already mentioned, today's topic is around checklist on standards auditing. So there was a webinar yesterday which covered few standards, and today again we are going to look at aspect of risk assessment and responses to assessed risk. So as all of you are aware, AASB has recently come out with checklist on standards on auditing. If you go back and look at it, there has always been a checklist which I would say an auditors would fill for, say, accounting standard compliances, Ind AS compliances, Companies Act, and so on and so forth. However, many of the practitioners or many of the auditors are out in not looking at the auditing standards very closely. And this has been, and therefore there has been a lot of observations around non-compliances with auditing standards in a lot of regulatory reviews. AASB has done a very good work wherein it has come up with a very exhaustive checklist covering all the auditing standards, which will help auditors like us to make sure that we have complied with the requirements of auditing standards. So the agenda for today is, as we mentioned, that few standards were covered yesterday. Today, we would look into more about risk assessment and responses to assessed risk. So we would be covering standard SA 300, which is planning and audit of financial statements, SA 315, which is regarding the identifying and assessing the risk of material misstatement through understanding of entity and its environment. We will look after SA 320, which is materiality in planning and performing an audit. SA 330, which is auditor's response to the assessed risk. SA 402, which is about a service organization, and SA 450, again an important auditing standard regarding evaluation of misstatements which are identified during the audit. So let's start discussing one by one auditing standards. What are the requirements of these auditing standards, and what is expected by as per from us as an auditor when we are performing audit procedures on any of the engagements. So, as it is said, well begun is half done. So, once Mr. Abraham Lincoln was asked, if you are given 8 hours to cut the tree, what would you do? And he replied back to say, out of those 8 hours, he will spend around 4 hours sharpening his axe and 4 hours executing it. So, when I am quoting this, what it means is effective planning leads to effective and quality audit at the end of the day. So planning especially is very, very important. What happens generally in our practical lives, as and when client approaches us, or as and when we plan our audits, we give very less importance to planning and engagement, maybe 5 to 10% of our time, and we directly start executing the engagement without understanding the importance of planning, or without, I would say, giving appropriate time to plan an audit engagement. Let's look at what is SA 300 all about. So, as we are aware, planning audit of financial statements has been given a lot of importance under the auditing standards. And therefore, there is a separate auditing standard which talks about planning and audit of financial statements. So basically, if you look at the overview of the requirement of the standard, the series of 300 to 499 talks about risk assessment and response to assessed risk. Out of the entire series of 300 to 499, there is a standard on auditing 300, which is planning the audit of financial statements. Now, this standard lays down the requirement regarding audit planning. And there has been an implementation guide which has been issued by ICAI on these standards. So this standard has been effective. It has been there for quite some time now. It has been effective for all the periods beginning on or after 1st April 2008. So let's look at the considerations which one should give while planning the overall audit strategy. So when you plan an audit strategy, what all aspects are very, very critical? What all aspects should be kept in mind? So the first and the most important aspect is financial reporting framework. So what is the financial reporting framework under which the audit would be done? Is it is it an US GAAP audit? Is it an Ind AS audit? Is it an IGAP audit? Whether the audit would be done under ISAs or standards of auditing. That is very, very critical. So financial reporting framework is extremely important. That clarity is extremely important. Only then an auditor would be able to assess appropriate risk, because there would be different risks which may arise as when the financial reporting framework changes. So take an example. Suppose there is a standard on auditing, there is an Ind AS which is applicable to an entity. The risk in certain line items would be quite different as compared to normal IGAP, which in case it applies to a particular entity. Therefore, financial reporting framework becomes very, very critical. Let's look at other considerations, industry specific reporting requirements. So as we all are aware, there are different reporting requirements in certain specific industries, especially in case those are regulated ones. So banks have certain specific requirements, insurance companies have certain regulatory reporting requirements, and BFC has a share of different reporting requirements. So therefore, it is very important that you understand what is the financial reporting framework, what are the industry specific, what is the industry in which an entity is operating, and whether there are any specific reporting requirements in that particular industry, because that will change your overall audit strategy. Third important point is consideration of audit evidence obtained in previous year audit, including IFC. So as we generally call it, cumulative audit knowledge is extremely important. So when we are doing an audit of an entity on a recurring basis, that means it is not your initial audit engagement. It becomes very important that we learn basis on past year experience and consider those experiences while planning the overall audit strategy for the current year. Another important aspect is while doing a planning, it is important to note whether we are planning for an interim audit or we are planning for a final audit, because at times the requirements would be different. The depth at which we would look at, or certain line items we may not look at interim and only at final. Therefore, it is important that while doing a planning, we need to ensure whether we are doing it for interim or final. Availability of client personnel and data. The most important aspect is many times our planning goes for a toss because the data was not received from the client on the appropriate, in the agreed and appropriate timelines. So whenever you are doing any audit planning, make sure that we discuss with the client well in advance. There is availability of client to support us for the audit, and the data is also available. Another important aspect is multi-location audit. Now, what is multi-location audit? In case of a company having components all over the world or having components in India, when I say components, subsidiaries, associate, joint ventures in India, there the multi-locational comes into picture. There we need to plan the group audit and certain additional standards on auditing needs to be looked into. Therefore, multi-location aspect is extremely important. There could be entities where there are no components or there are no subsidiaries, but the entity would be operating at different locations. They would be having different factory sites, etc. Even that should be considered because that is again an important aspect while planning an audit. Another important aspect is regarding developing an understanding of internal audit system. So we should understand what is an internal auditor scope, what has he covered, what whether there are any observations. If we factor in that at the planning stage, our overall audit strategy would be more effective. There could be certain red flags which you could note from the internal audit reports. Therefore, it is very important that we look at it at the initial planning stage itself. Another important aspect, and there is a standard which we will cover on this, is entities' use of service organization. So basically, when we talk about service organization, nowadays you will find a lot of companies outsource one or more of their processes. And these processes do have implication when it comes to financial statements because basis the transactions which are processed, the numbers are reported in the financial statements. So what happened in those scenario? How do we obtain comfort where an entire process has been outsourced to a third party or to a service organization? A lot of, I think I would say a lot of planning has to be done, a lot of coordination with the service organization along with management has to be done for such activities. And therefore, that is very, very important. And the most important critical piece is impact of information technology on audit. As we know that today the digital technology is changing at a lightning speed, it is very important that we factor in the information technology aspect when we plan our audit. So it is important to understand which systems are your client working on. What is the environment, control environment? What are the automated controls which you would want to test? Planning the expert involvement well in advance, discussing with management regarding the information technology and information security related aspect well in advance. I think that is again very, very key. So these are certain very key considerations which should be considered while preparing an overall audit strategy. Now, when an audit planning starts, there are certain routine activities which a auditor is required to do. One of which is risk and planning consideration. So in case of an initial risk assessment or initial audit for a new client, this has to be a very exhaustive activity where you would do an initial risk assessment and identify whether you foresee any risk in accepting the client. So basically the risk assessment of acceptance and continuance needs to be assessed. In case of uh, ongoing clients, you need to assess whether there is any risk in continuing with the engagement. Once that aspect is taken care of and we start with the engagement, then we need to look at the initial risk or this entity specific risk, that is identification of risk of material misstatements. So we would look into what is how to do the identification of risk of material misstatement in greater detail in SA 315. However, that is very, very important aspect while planning the audit engagement, because once you identify your risk, only then you will be able to decide what type of resources should be deployed on the engagement, what time should be spent, how much should be the senior involvement, what is the audit approach which should be followed, what are the audit procedures which should be performed by the engagement team. So therefore initial risk assessment becomes very important. Another aspect is once we identify the initial risk of material misstatement, then there has to be a planned audit approach to mitigate those risks. So for identified risk, the audit team has to brainstorm and discuss the planned audit approach basis the understanding of the entity. Another important role, IT systems and your previous year knowledge will play a very important role while planning the audit uh, for the next year. So please make sure that whenever you plan the audit for the next year's engagement, use the experience of the earlier team members in case there is a change in team members, and plan a more effective and efficient audit. Other aspects or other important aspects while planning the engagement would be around determination of materiality, whether there is any significant change in the transactions in the current year, whether there is any significant update in the current year, any significant business development, any changes in laws and regulations, like for example, ESG reporting for any entity, whether it was mandated to have an integrated reporting for this year. Such aspects are very, very critical when you plan an engagement. Therefore, it is very important that other qualitative aspects are also considered. What happens is when you do a risk assessment and you plan your overall procedures, then you would be able to better do the administrative planning, like which resources to deploy, whether the team has the required expertise, whether the team would be available, what all experts to involve, whether you would only need an IT expert or you need a valuation expert, you need a forensics expert. All that would become possible only when you plan in advance and do an assessment of risk. So that is again important consideration. Another very, very important consideration practically which you should give is when there are multi-location audits and you have large component teams, make sure that you plan in advance and communicate your group instructions to the component auditors in case you are not the auditors of the component well in advance, so that they can also plan their audit. Make sure whatever updates are there, you make them aware about it. You have a better understanding of subsidiary in case there is a significant update. So all these aspects are very, very important, and appropriate resource deployment, quality as well as quantity, is another important aspect which as an auditor we should consider when we plan an engagement. If we look at the standard on auditing, other standards on auditing and SA 300, so basically when you plan an audit in compliance with the standard on auditing, then the auditor will be able to form an appropriate audit opinion. So when doing a planning under SA 300, auditor should consider all the other requirements of all other SAs like SA 200, SA 315, SA 320. So basically, all the essays as well as SA 300 goes hand in hand. After doing a detailed understanding of the business, Only then only then an auditor would be in a position to plan an effective audit and prepare an effective audit approach. So now what happens when we say planning is extremely important? What is the impact of audit strategy on the audit plan? So financial review saw a few aspects which were very, very important as a part of overall audit strategy, which was the financial reporting framework. So once the financial reporting framework is finalized, the effect on audit plan is basically the auditor can assess that appropriate personnel who have requisite knowledge are there on the engagement. The engagement team or the engagement partner would be able to, basis the strategy, would be able to ensure that appropriate team members are there, sufficient team size is there, sufficient audit procedures and appropriate audit procedures are planned on the engagement. So basically, each and every consideration we spoke about has an impact on the audit plan, and therefore it is very important that each and every consideration is considered in detail to plan a effective audit plan or to make an effective audit plan. Another important aspect which we spoke about was of effect of information technology. So as we saw that nowadays, because of the digitalization and digital transformation in almost all of the businesses, involvement of IT experts become very, very critical. We need to assess which all applications are there, which all applications should be tested by our experts well in advance, coordinate with them. Because what happens is, if the automated controls or the IT general controls are not effective, then the audit strategy undergoes for a change. There would be a total revamp of the audit strategy. There may be certain new risk also which may come up. And therefore, it is important that we plan this piece extremely carefully, especially when there are complex ERPs in place and there are new clients where we are not very sure about the client environment in the first year. Or there have been scenarios where we have seen in the past that the IT general environment turns out to be effective. The controls, there are certain deficiencies which are noted. In those scenarios, engage with your clients well in advance and plan your audits effectively. Another important aspect is, as all of you all are aware, audit trail has become mandatory with effect from 1st April 2023. Again, those considerations should be given while preparing an overall strategy and making an audit plan. It would be important that the auditor engages with management well early in time to ensure that the reporting is appropriately done. So this would be largely the impact of audit strategy on the audit plan. So it impacts the selection of team, it impacts the engagement budget, all those aspects would be there. So in nutshell, if we look at the standard talks about that the auditor should give due consideration to each aspect to plan an appropriate audit. Now, the overall audit strategy should be documented in detail as a part of your audit file work papers. There has been an audit memorandum which is provided as an appendix in the implementation guide. You all can go through that format, but it's a exhaustive and a nice format wherein the auditor should use such formats to document the overall audit strategy. So basically, what all should be documented? As we all are aware, documentation is extremely critical. A detailed audit strategy along with the audit plan should be documented. It should cover the records of plan nature, timing and extent of risk assessment, and audit procedures which should be performed at an assertion level. We will go to and we will do a detailed understanding of what is the risk assessment at assertion level, at financial statement level in the next standard. But basically, a detailed audit strategy and audit plan should be documented. It should be a part of our proper. It should be part of our work paper, and it should demonstrate proper planning of audit procedures. Any significant changes. So what happens is, you do planning at the beginning of the engagement. It is said that generally you should at least spend 35 to 40% of your time, if not more, on planning an effective audit with the audit team, having a detailed discussion on the audit plan and audit approach. Now, over a period of time, as we receive a lot of information from the client, there are scenarios where the audit strategy, there are significant changes in the overall audit strategy and the audit plan. So the audit file should consider and should document the initial audit strategy as well as reasons or circumstances because of which there has been change in the audit plan and the audit strategy. and the approval or the discussion of that audit strategy with the engagement partner and the EQCR in case there is an EQCR requirement on the audit. So the audit work paper should demonstrate a detailed planning on the audit engagement, and therefore it is very, very important. The standards on auditing give a lot of importance to the audit planning. So this was about SA 300. Now let's look at SA 315. SA 315 is quite exhaustive and talks about identifying and assessing the risk of material misstatement through understanding the entity and environment. So basically, this deals with the auditor's responsibility to identify and assess the risk of material misstatement in financial statements. So how do you assess the risk of material misstatement? You do that through understanding the entity. You do that through understanding the environment in which the entity operates and the entity's internal control system. So these three aspects are extremely critical. So basically, the auditing standards objective is to identify and assess the risk of material misstatement to provide, which will help you to provide the basis for designing and implementing the responses to that identified risk. So once the risks are identified, there is another standard under which we need to assess and respond to the identified risk to ensure that the risk of material misstatement is reduced to an acceptably low level. Only then you can issue an appropriate opinion on the financial statements. So let's look at how to identify and assess the risk of material misstatement. So let's go back into definitions of what is audit risk, what is risk of material misstatement, what is detection risk, what is inherent risk, and what is control risk. So basically, if we look into the definition, what is an audit risk? Audit risk simply is expressing an inappropriate opinion on the financial statements. Uh, what is the objective of the audit? The objective of the audit is to reduce the audit risk to an acceptably low level. To reduce the risk to an acceptably low level, an auditor needs to assess the risk and limit the detection risk. Okay, so basically, if only an appropriate risk has been identified, then you can plan the procedures to mitigate and reduce it to an acceptably low level. So how could this be achieved? This could be achieved by performing procedures that respond to the risk which has been identified in the financial statements. It could be at an assertion level, it could be at the transaction level, it could be an account balance level, or at the entire financial statement level as well. So first, identify the risk and then plan the procedures to reduce it to an acceptably low level. Now, what is inherent risk? As we all would be aware, susceptibility of an assertion to a misstatement that could be material, and when aggregated with other misstatement, assume that there are no related controls which would operate around it. So inherent risk is something which is always there when you plan and perform your audit procedures. What is control risk? Control risk is a risk that the internal controls will not be able to, the entity's internal control system will not be able to prevent or detect the risk of material misstatement on a timely basis. So if we look at it, if we go back and see, basically what is an audit risk? Inappropriate audit opinion. Then comes the risk of material misstatement. There is an inherent risk which will always be there, and there is a control risk. Control risk is risk which controls are unable to identify and detect on a timely basis. Now let's look at what is the detection risk. Risk that an auditor will not be able to detect the material misstatement at assertion level. So that is the detection risk. Now, if we look at the standard, we saw that there is an audit risk, there is an inherent audit risk, there is a control risk, and there is a detention risk. Now, we always keep on hearing the word fraud risk and significant risk. So fraud risk and significant risk are defined in SA 315. So there are two types of, so what is a fraud risk? A risk of an intentional act. Okay, so the intentional word is very, very important here. So fraud risk is the risk that an intentionally one or more individuals among management, including the employees or third parties, they may misstate the financial statements. Okay, that is a fraud risk. So there has to be an intentional act to call it as a fraud risk, where one or more parties would do it for the purpose of misstating the financial statement, for the purpose of unjust or illegal advantage. So there are two types of intentional misstatements that are relevant from an audit perspective. So there is a gamut of risk. First, if you look at it logically, you will find that there would be a lot of risk. Now, every risk may not be an audit risk. So there could be a lot of risk, which could be business risk, like competition risk. The risk do exist, but it would not directly impact your financial statement. It may impact the revenue numbers. In turn, if the entity's health is not good, if it is not able to earn revenue, then going concern and stuff like that. But competition risk more from an operational perspective and would be a business risk. However, say overstatement of revenue, because of the competition, management has immense pressure, which leads to overstatement of revenue. That is something which would be impacting the financial statement and would be a presumed fraud risk. So basically, there are two types of intentional misstatements that are relevant from an audit perspective. Misstatement resulting from fraudulent financial reporting and misstatements resulting from misappropriation of assets. So from an auditor's perspective, these two risks are extremely important. So let's look at the interrelationship of audit risk and the risk of material misstatement. So basically, there's an inherent risk, control risk on the left-hand side. If you can see, there are combined risk, detection risk, and then those are bucketed into what would be a low risk, moderate risk, high risk. So it all depends upon basically the entity, the environment in which the entity would I would say operate. So when an auditor is identifying a risk of material misstatement, so our auditor needs to identify the risk of material misstatement as at financial statement level and then at assertion level for account balances, disclosures, or classes of transactions. So financial statement level. So basically risk that is relatively pervasive to the financial statements or may impact the entire financial statements. Those would be financial statement level risk which may impact a particular account balance. For example, say something which would impact, say, borrowings. That would be more of an account balance risk. Or take an example of management override of control, which is a default risk on any engagement. That is something which is at a financial statement level, and that could be a financial statement level risk. So auditor needs to identify risk at financial statement level and then at assertion as well as account balance level. How to identify the risk? So while doing an identification, ideally identification start with understanding of the entity. First of all, auditor should obtain a detailed understanding of the business of the entity, the environment in which the entity operates, and then the relevant controls which management has implemented in place. So first of all, the understanding of the business is very, very critical, because after understanding the business, only then the auditor could identify which all risks are there from a entity perspective. Then once the risks are identified, few of those could be operational risk or business risk, as we discussed. And out of those few, the gamut of risk which is identified by the auditor, there could be few risks which would impact the financial statements. Very important point here is always remember management override of control and risk of material misstatement due to fraud in revenue. These are presumed significant risk on any engagement. So we will see what is significant risk, but always keep in mind these two are presumed risk. That means you have to consider these two risks on any engagement. When it comes to revenue, in case you believe as an auditor that there is no risk of material misstatement due to fraud in revenue, it can be rebutted, but then a detailed documentation should be there why you believe risk of material misstatement due to revenue is not a risk on that particular engagement. Management override of control cannot be rebutted and has to be considered on each and every engagement, because management is in a unique position to influence the financial statements. Therefore, always keep in mind, do an understanding of the business, identify all the risks, bucket those risks into operational or business risks and audit risks. Out of those audit risks, then assess what is the level of those risks which you have identified as audit risks. There could be few risks which would be low risk, few risks which could be moderate, few which could be significant risk. So all that detailed assessment should be performed by an auditor. And another important thing is do the assessment at financial statement level also, and do the assessment at assertion and account balance level also. So after doing all these procedures, then auditor would come to a conclusion about the would be able to finalize that these are the risks which are there on the engagement. Another important aspect which you can consider in case there is a listed company, there's a lot of public data which is available. There are risk registers which are required to be mandatorily kept by the management under SEBI LODR requirements. So you can consider the risk register which is maintained by entity. You can go through the annual reports, see what is the risk which management perceives. There could be certain risk wherein you as an auditor may not be very fully aware of, but as a management, they believe that is a risk. So that would be another starting point when you would be preparing a gamut of risk, or you would be assessing the gamut of risk. This is your understanding of the entity. So consider all those documents, look at the business, look at the internal control environment, look at the understanding of the entity, look at the relevant controls, and then decide. And keep one thing in mind, control assessment should not be considered while assessing the risk. So there could be a risk, but if you believe that the controls are very strong to mitigate it, that will not influence the decision that there is a risk on the engage. So having strong controls does not mean that the auditor doesn't identify that as a risk. The auditor is not required to take due consideration of strong controls in place which have been put by the management. However, it is important that you understand the relevant controls so that you can assess whether there are any further additional risks which may arise because the control environment is not so strong. While assessing the risk, also consider the likelihood of the misstatement and the magnitude. So this is very, very important. So there could be n number of risks. Now, how do you assess whether that risk is low risk or whether that risk is high risk or significant risk? So these two aspects play very, very important role, likelihood and magnitude. So what is the likelihood of that misstatement happening? And what would be the size of that misstatement or the quantum of that misstatement, magnitude of that misstatement, impact of it on the financial statements? Basis that you will decide whether it is a significant risk or it is a, I would say, low risk. Now, when you perform the understanding of the entity, there are certain aspects which are very, very important. So when you do an understanding, it is not only internal business is what you understand, you also understand the external factors, because the external factors at the end of the day would impact the operations of the management. So understand the nature of industry. In case it's a regulated industry, you need to understand the regulatory environment. What are the regulator expectation? How is management making sure of compliance with those regulatory expectations or regulatory aspects? Financial reporting framework, again, very, very important to understand right financial reporting framework. Understand the governance structure, the ownership, operations. What is management's philosophy? What is their policy? What are the policies which are in place? What is the management's business philosophy? What is their key objective? What is the business strategy? All those aspects will help you to identify what all risks could be there in that particular engagement. Another important thing is when you would be auditing any entity, what are the accounting policies which are followed by company? That will also give you a sense to say whether the management is very aggressive or management has decently, I would say, a prudent policy in place. So accounting policies will talk a lot about certain aspects. So therefore, I think application of accounting policies appropriately is also very, very important. And then comes the other aspects which are very important is whether the performance of the management is linked to the incentives. So when we do a typical assessment, we call it as broad triangle. We look at incentive pressures and then the rationalization or the attitude. So we see what is the incentive to misstate the financial statements. What is the incentive which management has to do that? What are the pressures on management? There could be the I would say the entire variable pay, which is linked to the financial, which would be linked to the performance of the entity. Then in such scenarios, there could be a higher risk in those scenarios where the entire variable pay may be linked to the performance or the, say, revenue target of the management. So all those understanding is very, very important when you assess what is the fraud risk on that engagement. That is very, very important. Plus, what is again important is understanding the internal controls which are relevant to the audit. So there are two types of controls. When we talk about internal controls, the internal controls cover even the operational controls, but we need to look at the internal financial controls in greater detail. So we do an understanding of the controls that are relevant to the audit, and we see whether there is an appropriate design and operating effectiveness of those control by doing the inquiry procedures, observation, inspection of few documents. That gives you a sense about how is the control environment of the entity, and that brings you to the internal control assessment. So when we talk about the internal controls, there is a huge activity which is required to be carried out. But if we have to very briefly look at it, it talks about what is the control environment, what is the tone at the top, what are the policies, how is the governance structure, what is the entity's risk assessment process. So how do entity identify its own risk, whether it has a risk committee, whether there is an internal audit function who does monitoring of controls, how does entity do a risk assessment? That is again important aspect of internal control. Then another important aspect is information system and communication. So which are the systems, which are the ERP packages, what is IT policies of the companies, whether those policies, etc., are communicated to the employees at large. That is again very important. Then we look at control activities which are relevant to the audit. Now, control activities are generally controls which are implemented by management at a transaction level to make sure that there is no material misstatement while processing those transactions. Those would be the control activities. So basically, all others, I would say, all other aspects are more which would operate at an overall entity level, and control activities would be something which would then operate at transaction level. Monitoring of control, how does management itself ensures that the control system which they have implemented is operating effectively? So whether there is an internal audit department who would inspect that, whether management carries out certain checks and balances at an appropriate time, how is management monitoring it, whether there is an audit committee who does oversight on certain aspects. These aspects are very, very critical to understand how is the internal control environment of the entity. Now let's look at the risk assessment procedures. So what happens is SA315 also requires an auditor to do a risk assessment at the beginning of the audit, which is at the planning phase. So SA315 we apply with SA300 when we do the planning of the engagement. We do the understanding and risk assessment at the planning phase itself. So when we perform that, the SA mandates us to do a risk assessment procedures as well. Now, generally, these are analytical procedures which we perform. Now, how we perform these procedures? Generally, we take an interim data and then we do see whether there is any, we do an understanding of the entity, build our expectation to see what should be the numbers look like, basically, basis our discussion and inquiries with the management. When I say numbers look like, you don't predict the numbers, but you will understand, okay, there has been growth in revenue. In the industry in which management operates, same automobile industry, generally the industry is growing, client is also expecting a positive growth, so you will expect revenues to grow up. Suppose there are cost pressures, you will expect the margins to reduce. Such type of expectations are required to be built at the planning stage itself. So that is very, very critical. Another important aspect is having discussions with different stakeholders like internal audit function, management, management functions, inquiries with management itself, discussing with the IT department, looking at it if there has been any system migration or any plan of change in systems during the year. All these aspects are covered as part of risk assessment procedures. So always keep in mind that risk assessment procedures should be documented in your audit files while performing the planning on any engagement. You should at least document and see, you should at least obtain the interim information and see whether there are any fluctuations which are not in line with your expectation. What will happen is this will, suppose there is a revenue, you expect the revenue basis all the factors to go up, but it is going down. That gives another indication that there could be something else which you need to look into. So you can better plan your procedures in that particular manner if you look at the interim data and then plan it. So risk assessment is something which is very, very important. And there has been a lot of, I would say, regulatory observations around it that risk assessment procedures were not done appropriately or were done at the fag end of the audit. Because 315 and 300 requires it to plan effectively, these procedures should be performed at the beginning of the audit, at the planning phase itself. Otherwise, these procedures will lose its essence. So make sure that you have a working paper also which demonstrate that you have performed your risk assessment procedures. Now let's come to the significant risk. Now, what is a significant risk? So we spoke about different risks: business risk, operational risk, then comes to audit risk. And in audit risk, there could be a low risk, there could be a significant risk. Now, significant risk is very, very important from our perspective, because an auditor, whenever there is a significant risk which is identified, it requires special audit consideration. So it is more, the risk itself is very high. So auditor needs to make sure that there is a special consideration which is given while performing the procedures to that on that particular account balance. So it is defined as an identified and assessed risk of material misstatement that in the auditors or that from an auditor's perspective would require a special audit consideration. So auditor needs to exercise professional judgment in deciding what special audit consideration should be given or what special audit procedures should be planned in case of significant risk. The auditor shall exclude the effect of identified controls related to the risk. So effect of controls preventing that risk should not be considered when you assess the risk. Now let's look at the factors which should be considered for identifying a significant risk. Whether the risk is a fraud risk, that means whether there is a risk of fraud also in that particular risk. For example, say management override of control. It's a fraud risk and a significant risk. So that significant risk is a fraud risk because it's a presumed risk of fraud. Now, revenue, in case you believe there is a fraud risk in revenue, then again, it's a significant fraud risk because there is a presumed risk of fraud. There could be other risk also where you believe there is a risk of fraud, and therefore those would be fraud risk, significant fraud risk. So by default, you would say fraud risk would be significant risk, but not necessarily every significant risk would be fraud risk. So you may identify, say, some risk around or a significant risk around recoverability of trade receivables, but not necessarily it would be a fraud risk. It may be only a significant risk. You don't expect any intentional act of two or more people to misstate it. Therefore, it may not be a fraud risk, but it would be only a significant risk. Always keep in mind there are two presumed fraud risk, revenue and management override of control. So every fraud risk is significant risk, but every significant risk is not a fraud risk. So on your engagement, you can even assess that revenue, there is no fraud risk, but it is still a significant risk. Then you can rebut that fraud risk by having a detailed explanation why you believe that there is no fraud risk in revenue. Another aspects or another factors which will help you to identify whether it is a significant risk or not, whether the risk is related to recent significant economic, accounting, or other developments in the regulatory environment. What happens for very recent and complex development? The risk may be high because people's judgment or people's understanding to identify, to understand the particular requirement in a particular manner may be low. So in case of recent economic, accounting, or other development, there could be high risk. If you recollect, when there was a COVID, which had just hit the world, COVID-19 was generally considered to be a significant risk impacting the businesses. So if something of that sort takes place, or a new accounting standard which is very complex and has a significant impact on the business of the company, that may turn out to be a significant risk in that particular year. That is another important aspect. Complexity of transactions. So suppose a client engages into a very complex transaction. That could be an indicator that it is a significant risk. Transactions with related parties. Now, again, if there are voluminous transactions with related parties, generally we consider that as a significant risk and assess that those are appropriately reported and are at arm's length. Another important indicator would be degree of subjectivity involved. So whenever there is a professional judgment involved, whenever there are transactions where there is a lot of uncertainty when you calculate the numbers, for example, take any estimates. Like in case of entity where ECL is a complex calculation, ECL could be a significant risk. For entities where certain estimates are very critical, say impairment assessment, the working is quite complex and critical, as well as very material from the financial statements perspective, that could be a significant risk on the engagement. There is a one-off transaction or transaction outside the normal course of business, that could be an indicator of a significant risk. So always make sure that you look at these indicators and then assess the audit risk into two buckets, whether it is a significant risk or a low risk. Significant risk often relates, we spoke about this, non-routine transactions, wherein you believe there would be greater management intervention, complex calculations, non-routine transactions. There you will often find a significant risk being identified, or on judgmental matters, because there's a lot of judgment and subjectivity involved. A lot of estimates you will find are considered as significant risk by auditors on the engagement. So this is basically, I would say, square which shows what is the impact of risk and what is the likelihood of risk occurring. So if the impact of risk is low and the likelihood is low, and if the impact is low and likelihood is high, then it is not a significant risk. So basically, to identify the risk to be categorized as significant risk, it should have high impact on the financial statement, and it should have high likelihood of that being occurring on the financial statement. So we saw the likelihood and magnitude aspect. So the magnitude and likelihood aspect has to be high to categorically call out the risk as a significant risk, because that risk would require additional audit consideration. Always keep in mind when you do that risk assessment, don't identify each and every risk as significant risk, because significant risk is something which requires special audit consideration. If you have too many significant risk on the engagement, that itself shows that the engagement is quite risky, and then you may start questioning the acceptance and continuance procedures. So it's not that you should not identify significant risk. Identify it, but apply proper professional judgment to assess what is significant risk and what is, I would say, low risk. Too many not identifying significant risk is not appropriate, and identifying too many significant risk will lead to unnecessary lot of work to be done by the auditor on the engagement. So there has to be a proper balance, and for that proper balance, it is very important that senior team members are involved into the engagement, where they, through their expertise, can help the team to assess what are significant risks on those particular engagements. Another important aspect of SA 315 is risk for which substantive procedures alone would not provide appropriate audit evidence. So there are certain risks which are, or situations which are mentioned, where only sufficient appropriate audit evidence will not be obtained through substantive procedures, but a control related approach will also be required to be followed. So one more important thing is, for any significant risk, an auditor is required to at least understand the control environment and assess those controls. That means at least obtain an understanding of the control and perform the walkthrough. Even if ICFR is not applicable, still you need to perform the walkthrough. Whether to test and obtain comfort or not, that is based on your outcome of your understanding and walkthroughs. But understanding of control environment and walkthroughs is mandatory for any processes where there is a significant risk which is identified. Revision for risk assessment. Again, as we saw that there can be a revision to an audit plan because we obtain new information, we understand that there are new risks which are identified. So whenever we are performing our audit procedures during execution, there could be revision for risk. We may have identified certain risk as significant, but when we dwell into it, we may note that it is not it was not required to be identified as the significant risk, or vice versa. For any, say, estimate, we had not identified it as a significant risk, but when we look into it, we believe it is quite complex and judgmental, as well as very subjective, and therefore you can revise your risk assessment and then plan your procedures accordingly and document why the revision was mandatory. Now, what all to document under SA 315? Now, under SA 315, documentation should at least cover the discussion among the team and the significant decisions reached. So the discussion among the team around the risk assessment and why, basis the discussion, only these were identified as significant risk. A clear-cut documentation has to be there around those aspects. A detailed documentation about understanding of the entity, a detailed documentation about the internal control environment, sources from which the information was obtained, a detailed documentation of risk assessment procedures which are performed by an auditor. We discussed that it is required that we perform a risk assessment procedures at planning stage. So a detailed documentation of that, what are the identified risks, which all risks are identified, and out of those, how many are significant risks, and what are the planned procedures to mitigate those significant risks. A bare minimum documentation of these aspects is extremely critical. At the end of the day, it depends upon the size of the entity that how exhaustive the documentation should be. But even for a smaller company, at least a documentation should be there to say there was a team discussion, what was discussed, how a risk assessment took place, what were the risks identified, why were only few risks identified as significant risks, why those were decided to be called as significant, so on and so forth. You should also document in case of a continuing engagement, in case anything was identified as a significant risk in the previous year, but you believe that it is not a significant risk for the current year. A documentation should be there in your audit file to explain the same. Similarly, in case last year certain areas were not identified as a significant risk, but in the current year you believe that it is a significant risk, a detailed documentation to that extent also should be there in the audit file. So in nutshell, it's a very exhaustive standard. In fact, ISA or International Standard on Auditing has further amended 315 to include a lot of further aspects relating to the IT systems as well as earning and expending the cash and stuff like that. SA is not updated to that extent. So therefore, SA 315 as is remains, which was there earlier. However, it is very exhaustive and important that we do a detailed documentation. So if you go through the checklist on standards on auditing, you will find all these aspects which are covered in the questions there, where an auditor should mention, is required to mention what procedures it has done to make sure these auditing standard requirements are complied with. So let's look at materiality in planning and performing an audit. So this standard deals with materiality determination. Now, materiality, as we all are aware, it is very important that we look at the materiality and decide the materiality at the planning phase itself, because that will decide your audit approach as well as what would be the sample sizes, how much, what are the balances which you would want to scope in, whether a particular balance is material or not. All those decision making would depend upon materiality. So a concept of materiality is applied both by the auditor during the planning and performing the evaluation and the effect of identified misstatements on the audit. So basically, it is not only at the planning phase and execution phase, but at the end also, when you assess the misstatements which are identified, again, materiality plays an important role, because to assess whether it is material or not, you again go back to your materiality levels which were identified at the planning stage. So materiality can be looked at from three perspectives. One is entity's point of view, one is auditor's point of view, and one is users of the financial statements point of view. So if we look at the entity's point of view, it is a threshold at which the subject matter information becomes important enough. So you may at times find that particular item you may say as material, management may say, this is very small, this is not material from our perspective, because they would take a threshold basis their understanding of business, because or basis their threshold or basis their consideration what they believe is important for them, or what they believe is material enough for them to pay a particular attention. So it includes consideration of whether the reported subject matter information is free from material misstatement that would affect the decision of users taken on the basis of that information. What is materiality from auditor's perspective? From auditor's perspective, it will help us to decide the nature, timing, and extent of the evidence which we will gather and evaluate the misstatements at the end of the audit. So from an auditor's perspective, your plan of audit, your nature, timing, and extent would depend upon the materiality levels. From a user's perspective, any misstatement which will change the decision of the user on any particular matter turns out to be materiality from his perspective. So a misstatement item may not be material from management point of view, but if that item basis its qualitative assessment change the decision of the user who is relying on that subject matter information, that may turns out to be a material item from the user's perspective. Let's look at materiality determination. So from materiality for the financial statements as a whole is the overall materiality and the performance materiality. So basically, there are two levels of materiality which are mentioned here. One is the overall materiality and then the performance materiality. Now, what is overall materiality? So any misstatement over and above your overall materiality would lead to the material misstatement. Now, what is performance materiality? Performance materiality is an amount which is set by an auditor, which is below the overall materiality, to reduce the risk of material misstatement to an acceptably low level. So what happens is there could be, say, two misstatements which are identified during the audit, which exceeds your performance materiality individually, but may not, or maybe below your performance materiality, but may not exceed your overall materiality, or even that it is fine. So basically, performance materiality is a threshold which is given to reduce the risk of material misstatement to an acceptably low level. Okay, so your misstatements, uncorrected and undetected misstatements, should not exceed the overall materiality of the financial statements. Now let's look at how is overall materiality decided and how is performance materiality decided. So if we look at the overall materiality is determined as percentage of a chosen benchmark. Now again, there is a lot of professional judgment which is required to be applied here. What would be the starting point when you assess the materiality? So when you assess the materiality, it depends upon the type of entity. So for example, from a, I would say, users of the financial statement, you should look at it. What is that which users as the of the financial statement would concentrate on? So for a profitable entity, generally it would be PBT. For say startup entity, it could be revenue. For certain entities, investment entities, it could be assets value or total asset level. So these would turn out to be the benchmarks for determination of materiality. Now, for the benchmark, this is the business of the entity and how the users of the financial statements would look at it. Basis that you will apply a threshold to that benchmark. So the first step is to understand who are the users of the financial statement and what is that at which they are looking at. That is your first step in deciding the materiality. Then comes the type of entity. So basically, if users are focusing on PBT, generally the PBT would be the basis on which you would decide your materiality. And again, it depends upon business. So suppose in case of a loss-making entity, you can't take loss as a basis, then you would decide some other basis, maybe average profits or something of that sort. So for deciding the benchmark, pay attention to what users of the financial statements are looking at. And then basis the business of the company, look at the benchmark, decide the benchmark, and then apply a threshold. So once you take, say, PBT is your benchmark. Now, what percentage of PBT to take? Again, there are factors which will affect the identification. So one is what are the factors which affect the identification of benchmark? We saw that. And there could be factors which affect the identification of a threshold or application of a threshold. So again, it's a professional judgment. Now, whether to take 1%, whether to take 2%, there is a range which is defined generally in the standards, but what to take is again a professional judgment. Now, how do you apply that judgment? It again depends whether it is your first year of audit. If it is your first year of audit, generally you would want to be more conservative. You look at the control environment. In case of continuing engagement, you can look at the history of detection of material misstatements, whether you come across a lot of uncorrected misstatements in the audit. If that is the case, then you will lower your threshold. You will look at the IT environment. If the IT environment is, I would say, strong enough, good enough, you may increase your threshold. But if the IT controls are not strong enough, you may want to reduce your threshold. So all those aspects should be looked into while applying the percentage or threshold to the chosen benchmark. So in short, there is no one answer which will fit all the engagements. It again depends on the business to business, entity to entity, and the professional judgment which somebody would apply. Now, kindly note, these are only indicative ones, and this is not something which is given in the standard, but these are generally how the benchmarks are decided. So, for example, in case PBT is minimal, what would be the benchmark? In case of loss-making entities, what would be the benchmark? For mutual fund entities, what would be the benchmark? So similarly, an auditor applying his professional judgment and understanding of the users of the financial statement, what is that at which they are looking at, basis that they will decide the appropriate benchmark. So there are other factors also which should be considered. Regulatory environment, whether the entity has certain is bound by certain regulations, whether it is closely monitored entity like banks, NBFCs, where RBI governs closely, whether the entity, there are key disclosures in relation to the industry in which the entity operates. All those factors are very, very important to assess whether the materiality level is appropriate or not. Another important thing is like practically the materiality will be decided when you would be planning your audit. So there could be changes when you finalize your audit. So say you would have planned your audit basis XYZ projected financial statements. So how do you practically do that? Generally, you look at the users of the financial statement, you decide the benchmark, you decide the threshold basis your professional judgment, you take the projected number for the entire year. and then you decide the materiality levels. Now, when you take the projected number, there is a scenario that the actuals may be lower than the projected, that you need to revise the materiality and make sure that your audit is compliant at the lower materiality levels. There could be other scenario also that there is an upward revision. You can do that also. So always make sure that when you are taking the budgeted numbers, what is your experience with the entity, with the budget? Talk to management, take a lower number so that you don't end up doing a lot of, you don't end up having a downward revision and then again planning your audit procedures and assessing the impact. So make sure that there is a revision as the audit progresses to the materiality levels as well, especially on listed clients where we may do interim, then we have quarterly closures. That gives us better visibility about the profitability of the entity. And therefore, the materiality numbers should be revised as and when we have the further update, so that the audit will catch up with the recent materiality levels, because certain things may turn out to be material at a particular level, but not material at a particular, at a maybe say higher level. So therefore, materiality revision is very, very important. And again, last but not the least, documentation comes into the picture. The materiality consideration, what consideration were given, why a particular threshold was chosen, why a particular benchmark was chosen, all that needs to be documented in the audit file. So a documentation would be very, very important to demonstrate that an appropriate level of professional judgment was applied in determination of materiality by the audit. Now let's look at another interesting standard, which is SA 330, auditor's response to assessed risk. So we saw planning and audit, we looked at identifying and assessing the risk. So under SA 315, we saw that how an auditor is expected to identify and assess the risk. Now under SA 330, how an auditor should respond to assessed risk. So basically, once you identify the risk, then you will have to plan the response to those assessed risks to bring it to a significantly low level so that you can issue an opinion on the financial statements. So auditor's responsibility to design and implement response to the risk of material misstatement which were identified in accordance with SA 315 is the scope of this standard. Now, generally, when you plan your responses, so we saw that there are significant risks. There could be a low risk on the engagement. There could be fraud risk on the engagement. Now, how do you plan your responses? So for any risk, there could be substantive procedures. There could be test of controls. There could be a combination of both. Okay. So it depends upon the auditor's approach. It depends upon the control environment, whether the controls are operating effectively or not. So in case of any risk, an auditor should plan his procedures, deciding the substantive procedures, test of controls, and combination of both. Now, substantive procedures, when we say, it could be test of details, which is like verification of transactions. It could be substantive analytical procedures. Now, substantive analytical procedures is like taking the, I would say, building an expectation, arriving at the expected number, comparing it with the actual. It's a 4-step process, comparing it with the actual, and then looking at the variance, whether the variance is within the expected threshold or not. That is what is substantive analytical procedure. Generally, in India, we use substantive analytical procedures only on few, I would say only for few account balances like depreciation, where the amounts are very predictable, rent expenses, where basis the rent agreement, you can predict what should be the account balance and then calculate it and then compare it with the actual. Or say payroll expenses, where you can take the base of last year, do an expectation analysis basis the increment percentages, validate whether that increment percentage expectation is appropriate or not, arrive at the number and then look at the differences. In case the differences exceeds your threshold, then you need to investigate the entire difference, why there is a difference which exceeds your threshold. That is more or less substantive analytical procedures. Test of details is more or less verification of our samples, doing analytical procedures, doing a lot of inquiry procedures. That is all covered as part of our test of detail. And test of controls, as we all know, we understand the control, we perform walkthroughs, and then we test the operating effectiveness of the control. So there are two parts. One is design part of the control, whether the controls are designed appropriately, and second part is operating effectiveness. So whether those controls are operating in the way they are designed. If they are designed and operating effectively throughout the year, then you can rely on the control and take a combination of test of controls and substantive procedures. So if the level of evidence from test of controls is high, then the substantive procedures automatically go down, because then you will be able to obtain decent level, and it all also depends upon the assessed risk. In case of significant risk, you need to perform substantive procedures. You only can't rely on TOC. So you will have to do a combination of both, at least in the case of significant risk. Generally, you will find for every account balance, you will do a combination because of an ICFR testing. But in case if ICFR is not applicable, or ICFR the controls have failed, then the level of evidence which will be required from substantive procedures will be very high. So your sample sizes would be very high. You will do a lot of different procedures under substantive procedures to obtain the comfort on the account balance. So basically, when you design a response, you design an overall response to address the risk of material misstatement at financial statement level. So suppose there is a fraud risk on management override, then you will design a response at an overall level, how you would address it. That is an overall response. Now, suppose there is a risk of material misstatement at ECL, you will design specific procedure at that account balance level to make sure that the risk is brought to an acceptably low level. Whenever you are designing your procedures, make sure that there are experienced team members involved into it. The team applies professional judgment. There's a lot of supervision work which is done while preparing an audit plan. And always make sure that there is a unpredictability built in when you plan your procedures. Because what happens is we perform the same audit year on year. So it becomes very predictable for client also to predict what we would be asking for. So there should be certain unpredictable procedures which should be incorporated when we plan our audit procedures. So when I say audit unpredictable procedures, you can do an inventory count, not at year end, but in between. You can plan certain site visits, which would be unpredictable. You can call up certain employees and talk to them to just see that the existence of employees is there. So there could be n number of procedures which you would not be doing on a regular basis, but you can change anything. I mean, you can change the procedure, or you can change the timing of procedure. Even if the timing of procedures change, that also brings some aspect of unpredictability into your audit files. So make sure that that unpredictability aspect is taken care of, and we specifically document that how we have ensured that unpredictability has been built in. Another important aspect is basically basis the assessed risk, design the audit procedures to make sure that the likelihood of material misstatement has been taken care of, and whether the risk assessment takes into account the relevant controls which are operating effectively. So basically, when you are designing the audit procedures, see that the risk is brought to a sufficiently low level. You obtain the required level of evidence which should be obtained, and the audit evidence is more of a persuasive evidence which give you higher level of evidence to bring that risk to a, I would say, acceptable level. So design the procedures which will give you sufficient appropriate audit evidence. TOCs. So basically, when we design TOCs, TOCs are generally designed at assertion level only. We for a particular assertion, there could be certain controls. We test those controls to see whether those are operating effectively. First, we test the design and then operating effectiveness. If both are there, then we can rely on those controls. That will help you to reduce your level of evidence required from substantive evidence, substantive procedures. So control testing for clients where you can rely on control, do it. That will give you again a level of comfort. Plus, that will also help you to reduce your substantive audit procedures, and it will give you a good level of evidence as well. Because generally what happens is we have that mentality where even if TOCs are there, we want to still continue with whatever substantive procedures we do, because only substantive procedures give us the required level of comfort. But that leads to a lot of over audit. So I think we should leverage test of controls where we can. So again, extent of TOCs depend upon the frequency of performance of control, length of time, and things like that. One thing which is very important here is there is an approach of rotation of controls. So a control which is tested in this year, not necessarily every cycle needs to be tested every year. Once in a 3 years also a cycle can be tested. There are certain conditions which are given, and the detailed guidance is also there in ICFR guidance. So those guidance, if applicable, you can rely on that control basis your last year's testing. In case there is no change in facts and circumstances, there's no change in process, you have done your walkthrough to understand the process is exactly similar, you can do that and then test the controls once in 3 years. That also can be done. So it is reliance over a period of time, basically. Again, evidence is obtained in previous audits. You can consider that while planning your audit procedures. So basically, when you are designing your audit procedures, design your audit procedures to mitigate the risk at financial statement level. Uh, to do that, you need a lot of professional expertise, so professional skepticism and experienced senior team members involved. Build in unpredictability, change the nature of timing, extent of procedures at certain places to bring that unpredictability. When you are performing at assertion level, perform TOCs, perform substantive, use a combination of both. And then basis both the procedures which you have performed at FS level as well as assertion level, evaluate whether the risk of material misstatement is mitigated, and then conclude whether the sufficient appropriate evidence has been obtained. If a sufficient evidence has been obtained, then go ahead and you can issue your opinion. In case there are issues, then obviously you qualify your opinion or accordingly you disclaim your opinion. When you do an entire risk identification and assessment of risk process, again, documentation comes into the picture. So the overall responses to address the risk of material misstatement has to be documented in the file. So when you document your risk identification, also document your plan to mitigate the risk. Link those procedure with the assessed risk at assertion level. So when you assess the risk, when you do the assessment under 315, for every account balance, we need to assess the risk at assertion level. So link the procedures, the planned procedures to assertion so that you don't miss out on any assertion. What happens is at time we may do a lot of procedures for a one particular assertion, but we may miss out on certain other assertions. So make sure that for each assertion, we have done sufficient procedures to obtain the comfort. And then the results of the audit procedures, including the conclusion. So anywhere in case there is any change in strategy because the controls were not effective or substantive procedures led to certain identified misstatements which led to change in overall audit plan or new risk got identified, document all that along with the response to the assessed risk. Now let's quickly look at SA 402. Now SA 402 is audit consideration relating to an entity using a service organization. So we quickly saw that this basically deals with auditor's responsibility to obtain evidence when the client is using one services of one or more organizations. So take an example, payroll. It's a very common example where payroll is outsourced by the entity to a third party service provider. Now, what happens is, as an auditor, we need to obtain sufficient evidence on payroll as well. But when we look at it, then the process itself is outsourced. Then how do we obtain that comfort on the outsourced process? Because we need to do a reporting under ICFR as well as on the financial statements. So this essay helps us when such processes are outsourced by the client to one or more service providers. So the objective is basically to understand the significance of service organization and the effect on the entity's internal control system, and how do we obtain sufficient appropriate audit evidence so that we can design appropriate audit procedures there. Now, basically, the standard says obtain an understanding of the services which is provided by a service organization. So now let's go back again to SA 315. We need to do an understanding. If you recollect, we had seen in SA 300 that when we plan an audit approach, we also take into consideration, we do inquiries with management to understand in case there are any service organizations which are involved. Now, in continuation to that, when we do SA 315 understanding, we understand how many processes are outsourced, to whom they are outsourced, what is management's review on those processes. So even if payroll is outsourced, management would be seeing the entire payment system, or at least looking at it, what the third party has sent to them. So all that understanding becomes very important because that will make that will give you an understanding of the nature of services which the service organization is providing, how significant those are, and what is the impact on financial statements, how material those are, what is the nature. That understanding you will only get when you do an understanding of the business and understand from management what all processes are outsourced. Now let's look at the what happens now in case say payroll process has been outsourced. Now the auditor needs to determine whether a sufficient understanding of the nature of and significance of the services provided by the service organization has been done. So what happens is once you understand a payroll is outsourced, then you decide that how would you want to obtain comfort. So there is a process which is outsourced. There is a risk attached to that process. Now you decide how you would want to obtain the comfort on that process. It can be through different ways. So the most commonly used way is obtaining a type 2 report. We call them as SOC reports. So generally what happens is this service organization would appoint an auditor who would do a detailed study of the controls around the processes and issue an opinion on the control opinion on those processes. That is called as a type 1, type 2 report. So that is the commonly used reports by the auditors to rely that the service organization to whom the process has been outsourced has been the controls there are operating effectively. Another way to do it is contact the service organization, visit the service organization, understand the information, understand the control at his end. See, what happens is you can visit it, you can understand it, but you will not be able to test it, and therefore these type 2 reports will be able to provide you the required level of evidence. So whenever there is a service organization, talk to your client, ask them to take a type 2 report from the service organization. Now what happens is practically type 2 report you will easily get for say example payroll, but you will find that the period of type 2 report may be different. So the report may be say from Jan to December, but from an ICFR perspective you would be reporting, and from a financial year perspective also you would be reporting for the entire year. Then there is a bridge letter which is available for the balance 3 months period from say Jan to March. So please ask for that. Please look at the period of the SOC report. Another important aspect is look at what controls are mentioned in the SOC report. Those controls or those risks and those controls should be able to mitigate the risk which you identify in that process. Say from a payroll perspective, if there is a risk around incorrect calculation, there should be control in the report which will be addressing it. So go through that list. Only obtaining report is not appropriate. We should go through that report, see whether those controls which are identified and tested there make sense, whether there are any deficiencies identified in those controls. In case yes, what were the type of those deficiencies, whether that would lead to any impact on your financial statements, whether that would lead to any qualification in your audit report. So assess those reports very, very carefully whenever you obtain those reports from service organization. Now, as audit trail is also mandatory, make sure that the service organization reports controls also mention about the maintenance of audit trail in the system which is used. That is again very critical when you would be reporting on the audit trail. So talk to clients, take the type 2 reports, go through those reports, see whether those reports address the required controls, what were the observation of that particular auditor, and whether you need to do anything further, whether there is any reporting required or whether it helps you to obtain the required level of evidence. It satisfies, it will help you to provide you with the required level of evidence. Whenever you take a report, also look at the service auditor's professional competency and independence. He should be independent and the party should be professionally competent. That evaluation has to be done. That responsibility is of the user auditor. If the user auditor plans to use those report as an audit evidence, evaluate whether the description and design of the control is appropriate, period is appropriate, the operating effectiveness, sufficiency, all those aspects which we discussed, all that evaluation needs to be done by the auditor. Now, what happens when an auditor's risk assessment, when you do a risk assessment, you identify a risk and when you plan the procedures. Now, your expectation would be that the service organization report would be clean and all the controls would be operating effectively. Now, you can obtain a type 2 report, perform the appropriate test of controls, and then using another auditor's report. So there are 3 options available. You can take type 2 report, you can perform the appropriate test at the service organization, or use another auditor's report for test of controls to whom the service organization would have been involved. So basically, when you are doing TOCs for any process which is outsourced, you need to follow one of these three approaches. The commonly followed approach is the type 2 report. Now, what happens if the auditor is not able to get a service organization report and is not able to obtain any further evidence, is not able to do testing, no report is available, then he should modify his opinion. Second thing is, in case the report is obtained and the controls are operating effectively, the auditor is appropriate to get the required evidence. He should use those, document that as a part of your work paper. He should not report the work of a service auditor in his audit report. The standard prohibits the usage, reference of use of work of service auditor in the auditor's report. So it is different as compared to the subsidiary auditor. In the consolidated opinion, you can draw a reference, a carve out of the work which is not done by you. You can draw a reference to another auditor, but that is not allowed under this particular standard. You can't draw the reference to the work of a service auditor unless required by a law or regulation. So in case a law or a regulation requires you to do that, then you can do that. But there also the user auditor will not be able to diminish his responsibility. He should also indicate that this does not mean that his responsibility is less. So therefore, practically, I have never seen any report drawing any reference to a service audit. In case there is a modification, then the modification, the auditor report shall indicate that the such reference does not diminish the user's responsibility for that opinion. So this brings us to an end of service organization. So what is very critical from a service organization perspective? Understand how many service organizations are involved in any entity. Okay, that understanding is very critical because there are n number of processes nowadays which are outsourced, which could have implication on financial statements. So obtain that understanding from the client as a part of your SA 315. Talk to the client, ask them to engage with service organizations well in advance for the reports. Look at the prior year reports, see whether those are addressing the risk. If not, if you need anything in advance, talk to the client and tell the service organization what exactly you need in advance. Make sure the entire period of your audit is covered. So it should not be for a partial period, entire period should be covered. These are very critical aspects from a service organization perspective. And again, the documentation of all these controls, documentation of the usage of this report and evaluation has to be there as a part of a work paper. Now, this brings us to the end of the last standard for today, which is SA 450, evaluation of misstatement identified during the audit. Now, we saw that we identify the risk. Then we saw that there are responses which are drafted to mitigate the risk. And then we perform the audit procedures as per the responses drafted. Now, when we perform the audit procedures, there are certain misstatements which we know. There could be two types of misstatement. One could be corrected misstatement. That means an auditor identifies a misstatement and points it out to the management, requests the management to correct it, and management has corrected it. Those are called as corrected misstatements. And then there are uncorrected misstatements. So these uncorrected misstatements are the misstatements which auditor has identified but are not corrected by the management. So those form part of uncorrected misstatement. So this standard deals with the auditor's responsibility to evaluate the effect of identified misstatement on the audit and on the financial statements. So whenever an auditor identifies the misstatement, in case those are uncorrected, it will have impact on the financial statements. For corrected, it will still have impact on the audit process per se. So auditors need to deal with the responsibility of evaluation. So objective of the standard is to evaluate the effect of identified misstatement and effect of uncorrected misstatement on the financial statements, if any. Now, what is misstatement? Very interestingly, a difference between the amounts classification, presentation, or disclosure of a reported number in the financial statement and the number that should have been reported would lead to a misstatement. So it says a difference between the amount, classification, presentation, or disclosure. So it's not only the amounts, but even classification and presentation disclosure is also a part of evaluation of misstatements. So there could be a scenario where an item could have been presented in a particular manner, but it is as per the applicable reporting framework, but was not presented in that particular way. So therefore, it turns out to be a disclosure misstatement, presentation and disclosure misstatement. For an item which should have been classified, say non-current, is classified as current. It turns out to be a classification misstatement. Amounts is obviously when you come across a different amount which should have been recorded as compared to what management has recorded, that would turn into be an amount related misstatement. Misstatement can arise from fraud, can arise because of any error, inaccurate information, incomplete information, omission of a particular recording, incorrect accounting estimate. There could be a accounting estimation error which management would have done. There could be different judgment which an auditor would apply and a management would apply. That judgmental difference may also lead to a misstatement. So generally there are two types of misstatement. One is factual misstatement, one is judgmental misstatement. When an amount can be ascertained and is factual in nature. So say for an example, the invoice is of 100 rupees but incorrectly recorded as 80, the 20 becomes a factual misstatement. But take an example of ECL. When an ECL calculation is taking place and there are certain assumptions where there is a difference of view between difference of judgment between management and auditor, that becomes a judgmental misstatement. So every misstatement ideally should also be looked at as whether it is factual or whether it is judgmental misstatement. When an auditor expresses an opinion on the financial misstatement, he should make sure that the entire misstatements which are identified should not exceed the materiality levels which we spoke in the materiality standard. Otherwise, it would lead to a qualified opinion. And accordingly, the then accordingly, the opinion should be modified. What are uncorrected misstatements? Misstatements that the auditor has accumulated during the audit and which have not been corrected by management are uncorrected misstatements. So during audit, you may come out across several errors which management would have done. These are all uncorrected, and if they are not corrected by management at your request, then these turns out to be uncorrected one. Now, what are accumulation of identified misstatements? So the way the standard is drafted, it says that when you plan your audit and when you do your audit, you should accumulate all the identified misstatements, because these identified misstatements may give an indication towards inappropriate control system or control deficiencies in few controls. It may give an indication towards how is the tone at top. It will help you to do your evaluation in the next year. So all the statements which are identified during the process should be accumulated and documented in the audit file, even if those are corrected. You should give, when you identify a misstatement, the auditor should see its impact on the overall audit strategy, the nature of identified misstatement, their occurrence, why the misstatement would have occurred, whether it is material, aggregate of that misstatement, whether the total misstatements which are identified, say there are 5 misstatements, aggregate of it, whether it approaches our materiality which is defined, whether there are certain misstatements which are not corrected at the request of auditor. All these evaluation will have an impact on the audit strategy. If you identify a misstatement in a particular balance, you would go ahead and increase your sample sizes, your audit procedure on that particular balance to make sure that the risk of material misstatement has been reduced to acceptably low level. So all these procedures needs to be planned, and therefore it is very important that the auditor accumulate it and assess the impact of these misstatements on the audit plan. Another important and very important aspect regarding the misstatement is communication and correction of misstatements. So on a timely basis, auditor should communicate all the misstatements which are accumulated during the audit to the management, and you should ask management to correct those misstatements. So there has to be a communication to management about all identified misstatements, even if those are judgmental in nature. Management auditor should still communicate it to the management, explain the management why auditor believes that the judgment which management has taken may not be appropriate. If management refuses to correct misstatements which are communicated by the auditor, then the auditor shall obtain an understanding why management doesn't want to correct those. So that understanding the reason and the rationale for not correcting should be done by the auditor, should be also documented, and then basis that evaluate the impact on the financial statements. So if it exceeds your materiality level, you will have to qualify your opinion and accordingly do the documentation. So In making the determination of, while doing the evaluation of uncorrected misstatements, the auditor should consider the size and nature of misstatements, its impact, and its importance to the financial statements. Another important aspect is you may come across certain misstatements in the current year. Those could have been potentially going on for, say, few years, prior periods as well. Whether these misstatements had impact, have any impact related to prior period balances, that also needs to be evaluated. If there is a prior period impact, whether there is a need, whether it is material enough, and whether there is a need of then the restatement of prior year accounts is another evaluation which an auditor should do. If it is a carry forward balance, it may have an impact on your next year's also. So it is very important that whenever an misstatement is an identified, a senior team members does an evaluation of that entire misstatement on the audit, and then considers the importance or the size of that and the impact of that misstatement regarding the on the entire financial statements as well as account balances, and the effect of that misstatements on the prior year balances as well. As we saw that an auditor is required to communicate all the misstatements with those charged with governance. So it should communicate it with audit committee wherever audit committee is applicable. It should clearly state about that those misstatement individually or in aggregate, whether has an impact on the opinion or not. You should communicate all the identified uncorrected as well as corrected misstatements. And he should also communicate whether any of the misstatements relate to the prior periods. A brief about it should also be covered in written representation, should ask the management to cover the misstatements in the written representation as well. So management should, the auditor should request a written representation from management and those charged with governance, whether they believe that these in aggregate will have an impact on the financial statements. So a summary appendix is generally presented to the financial statements with all the corrected and uncorrected misstatements being mentioned there, along with the impact on the control. Another important thing is when you identify a misstatement, also evaluate the impact on the control environment. Suppose if you are required to opine on the ICFR, what is its impact on the control reporting? Why that would have been missed out? Why we believe there are, whether there are any other, which controls have failed that they were unable to detect that particular misstatement. All those aspects should be clearly looked at. We should also see whether those misstatements, obviously we would communicate it with those charged with governance, whether has any other implication from other account balances perspective as well. So all that also should be very closely assessed. And then obviously the documentation will follow. The auditor should accumulate all the misstatements and document them along with the rationale for corrected, uncorrected, how he has closed those, whatever are the uncorrected, whether they exceeds the materiality level, communication with those charged with governance, why management didn't correct it, referencing to the written representation, to your final communication with those charged with governance, audit committee deck. All those communications and documentation should be there, that why auditor believes that the uncorrected misstatement are individually or in aggregate not material to the financial statements, and in case material, along with the impact on audit opinion. So entire clear chain of documentation should be there, which talks about the accumulation of misstatements and the disposal of those misstatements along with the impact on audit plan, audit strategy, representation letter, and communication with those charged with governance. So this is what was all I had to discuss today regarding checklist on auditing standards, which covered 300 series standard and 402 and 450 around misstatements as well as service organization. So thank you very much for the patient listening, and would be happy to take questions if any.
Thank you so much, ma'am, for covering all the standards of 300 series. Ma'am, we have received certain queries.
Yeah.
Ma'am, first question is, uh, do we require to document the consideration in establishing the overall strategy, or is it sufficient that we document the audit strategy only? Can we combine audit strategy and audit plan in the case of small entities and for the branch audits?
See, for an small entities, you can combine the overall audit strategy and audit plan. But what is very important is what all considerations were given while developing that strategy. There has to be a brief explanation on that. As per the requirements of SA 300, you can combine the both the things, basis the size and nature of the entity.
Yes, sir. Ma'am, one member is asking, can you please elaborate the difference between design and implementation and walkthrough?
Yeah, so I'll tell you, walkthrough is basically taking one transaction and understanding the entire flow of transaction from initiation, recording, and its impact in the financial statements. So basically, walkthrough is done to evaluate the design of the controls and starts from initiation till recording of the transactions. So walkthrough is a procedure to assess the design of control.
Yes, sir. And ma'am, one question is relating to the risk classification. Is the total risk classification is the total amount of the financial statement item to which the risk is related can be taken as the magnitude of material misstatement?
No, so basically, see, for every line item, there would be a financial statement total. So take an example of revenue. There would be a total of revenue. So obviously, revenue would be material and in scoped item. That doesn't mean that everything would fall under the magnitude criteria. What is auditing standard trying to tell you is whenever a balance is material, you need to assess what is the likelihood that there would be a risk of material misstatement and what would be the magnitude. I mean, what would be the extent of that risk of material misstatement, whether it will exceed your materiality level. That is what then evaluation is required to be done. So if you believe that there is a likelihood and the magnitude, if you believe that it would be at such a scale that it would be material to the users of the financial statement, then the magnitude box will also be ticked. It doesn't by default means that every balance which is material will have the magnitude. Generally, it will be a combination of your account balance as well as your professional judgment that you believe that there would be a magnitude which would be involved in this.
Ma'am, can you put some light or some real life examples which would be helpful in knowing the factors that can help to determine the likelihood and magnitude of risk?
Yeah, so I'll give you a simple example. Now, take an example when we do an assessment of revenue. The likelihood of risk of material misstatement may be high. Now, that likelihood, say, may be high because of management pressure on management to achieve certain targets. Now, when it comes to magnitude, the first aspect which you would evaluate is what is the account balance. The account balance is material. Yes, it is material. Then, if you look at the revenue, you will find it would be multiple times of your I would say of your materiality number. Then you would assess whether you believe in case there is any misstatement in this, whether that would be material enough. Most likely your answer would be yes, because the number itself is significant enough that the misstatement would be material. And therefore your evaluation would be yes, it is the likelihood and magnitude boxes are ticked. Now let's take an example of say legal and professional expenses. Now, legal and professional expenses, you foresee a risk that there could be a say prepaid element is not appropriately bifurcated. So there could be, you would say, there could be an overstatement of an example. Hypothetically, take an example, there is an overstatement risk which you believe in a entity which is cost plus entity. Then what would you do? You would evaluate likelihood you believe is there, magnitude. Now, legal and professional expense balance, if you compare it with your materiality, it is just above your materiality. It is just material. So do you believe that the entire statement, entire legal and professional, there would be that risk of overstatement? So see, basically what happens is the account balance is just material and you believe that there is a likelihood of overstatement by not segregating the prepaid expense. So do you believe in that entire legal and professional expense? The prepaid element would be such magnitude that it will lead to a risk of material misstatement. Generally not, because your entire expense itself would not be very high. It may be material, it will be material, but it will not be so high that your risk of material misstatement would increase. Another example where I can give you, say, take an example of other income. You see some risk there, but then you assess whether basis that risk, the risk of material misstatement from an amount perspective, whether it will exceed your materiality level. So whatever risk you believe is there in that particular line item, when you are assessing that risk, you believe that the quantum of that risk would lead to a misstatement which will exceed your materiality level. That is how you should assess that the magnitude is there or not.
Yes, ma'am. Thank you, ma'am. One more question, ma'am. Is all the auditing standards are applicable for internal audit also?
See, these are standards on auditing which are applicable when you conduct the statutory audit. When you carry out internal audit, there are separate set of standards which have been come up by the by a separate. I mean, there's a separate guidance which is available. So all these standards would not apply when you do an internal audit. These are standards which apply when you perform a statutory audit engagement or you perform an engagement under standards on auditing. So suppose even if you are doing a special purpose engagement, but you are doing that under standards on auditing, wherever you use the gas as standards on auditing, there you will have to apply these standards. Wherever there is no gas of SE which you use, there you need not apply these standards.
Yes, ma'am. Ma'am, finally, while auditing, it is the responsibility of the auditor to check the compliance of all the standards.
Yes, it is the responsibility of an auditor to ensure compliance of all the auditing standards which are applicable.
And how to check the compliance, ma'am?
Yeah. So to ensure that all the auditing standards are complied with, like AASB has come up with a checklist, which is a very exhaustive checklist if you would have gone through it. So basically, you need to make sure that you fill the entire checklist, cross-referencing it to the procedures which you would have performed in your working papers. That will help you to ensure that all the auditing standards are complied with. This requirement was there always. It is just that we now have a checklist where we can ensure that we are not missing out on any requirement of the auditing standard.
Yes, sir. Ma'am, one last question. Extent of auditing standard documentation that is required to be maintained for audit of small entities.
See, there are a lot of standards where there is an explanatory material covered on what you should do for small entities. But generally, you will find that what you can do is, I would say, you can combine documents like audit plan and audit strategy and stuff like that. But yes, things are still required to be done until and unless it is very specifically written in the standard that for small entities only these aspects are required and rest of the aspect need not be taken care. So you will find in a lot of auditing standards that wherever they say that basis the size of the entity in case of smaller entities, these are the bare minimum things which you need to do. Only then at least to that extent you can apply the standards. But you will find more or less everything is covered. It is just that you can combine a lot of information into one document and make sure that your documentation is more effective and efficient. But largely all aspects are still required to be done.
Yes, ma'am.
You can't miss out on any critical aspect. You can just leverage the documentation and use it more effectively.
Yes, ma'am. Thank you so much, ma'am. Now we come to an end, and the recent checklist on various auditing standards we have already come out with the same, and that is hosted on our ICAI website on the AASB platform. And at the top, it is blinking in the red bullet. This is regarding our this checklist. So any member can download the soft copy of this audit checklist from our website.
Yeah, and I think it is available in both Word as well as PDF format.
Yes, yes,
So
it is
it is
available
very
on both
useful.
Word as well as in PDF. So those who wants to download in Word format, then member can download in Word format, and those who want to download in PDF format is also available, ma'am.
Yeah, yeah.
So if right now you are having the link, you may please share the link, ma'am, or if presently you are having the link.
Yeah, yeah. I have the
It will
link.
be
I will
helpful
share
for
it.
our members. Yes, ma'am.
Yeah,
Yesterday
I
there was
will
a
share it in the
curriculum.
chat box. Yeah,
Yes,
I'll
ma'am.
just share
Yes,
it.
ma'am. Yes, ma'am. So thank you so much, ma'am, for spending your valuable time for enlightening all of us on various intricacies as well as the various methods and checklists used for SF300 series for various standards. So on behalf of Auditing and Assurance Standard Board, we extend our thank you so much from AASB of ICAI for your deliberation and for spending your valuable time. Thank you so much, ma'am.
Yeah. Thank you so much. Thank you so much.
Thank you.